Usually, when we talk about financial analysis on this show, you probably picture this massive mountain of paperwork.
Right, like a dense 50-page prospectus.
Exactly. You imagine these really dry academic research papers or, I don't know, spreadsheets with thousands of rows of data that just make your eyes cross. But today we're doing something a little different for our deep dive.
Yeah, we essentially have the menu, but we don't have the meal.
That is the perfect way to put it. We are unpacking this really fascinating digital fossil from June 2026, and it's looking back at a financial event from the very end of 2025.
And just to be clear for everyone listening, we don't have the actual event. We just have the wrapper.
Right. We specifically have a few lines of promotional text, some metadata, and these really heavy legal disclaimers surrounding a video. And the video is titled Eaton Corporation PTN Q4 2025 Earnings Call.
Which is wild because we don't actually have the video itself. It makes this whole deep dive, this exercise in forensic architecture.
Forensic architecture, I like that.
Well, I mean, we are analyzing the scaffolding around the data, right? This tiny microscopic source. It's literally just a paragraph of text, but it acts as this perfect, pristine blueprint for the entire modern financial information filtration machine.
It is the wrapper without the candy. So we know a video exists out there somewhere in the digital ether, and it covers Eaton's Q4 2025 revenue, their margins, and, their forward guidance.
All the heavy-hitting stuff.
Yeah, but our source material today is entirely the legal and promotional architecture surrounding that video. And the reason you should care about this, the reason we're dedicating a whole deep dive to this wrapper is because this is exactly how financial information is packaged, filtered, and served to you today.
Right. It's the ecosystem.
Exactly. So let's unpack this and let's start with the bait, because the text explicitly promises that this video is going to cover, quote, the latest quarterly earnings results, key financial metrics, and business highlights from the most recent reporting period for Eaton Corporation, ticker ETN, for Q4 2025.
You really have to consider the phrasing there. Latest quarterly earnings results, key financial metrics, and business highlights.
It's very specific.
Oh, it is not accidental language at all. It is highly, highly optimized search engine bait. I mean, the creator of this text knows exactly what strings retail investors are typing into the search bars of YouTube or X.
Yeah, nobody is typing in corporate communication update.
Exactly. They aren't looking for the dry corporate talk. They are looking for the raw, volatile metrics. And Q4 is the ultimate prize in that ecosystem.
Because Q4 brings a full year wrap up.
Right.
And the forward guidance for the next 12 months.
Right. The stakes are just so much higher.
But let's look at the mechanics of this tease, because I think it's fascinating. It's constructed almost exactly like the text you would see on the back of a thriller novel, or like a movie trailer.
Oh, that's a great analogy.
Right. Because it promises you all the adrenaline. It promises you the business highlights and the key metrics, but without actually spoiling the numbers in the text itself.
It holds the tension.
Yeah. The entire purpose of this paragraph is basically just to act as a conversion mechanism. It just wants to get you to click play.
Well, that mechanism relies entirely on an information gap. So the text establishes that this vital data exists. It implies that the data is critical mainly because it's that Q4 wrap-up we just talked about. And then it positions the video as the only bridge across that gap.
So if you're holding ETN, you feel like you have to watch it.
Oh, absolutely. If you are holding ETN, or even if you're considering shorting it, the psychological pressure to close that information gap is just immense. And the aggregator knows this. They are literally monetizing your need for certainty in what is, let's face it, a highly volatile market.
Okay, you just used the word aggregator, and I think that is where the plot of this deep dive actually thickens.
Yeah, it's the core of the issue.
Because if Eaton Corporation is this multi-billion-dollar entity that's generating these results, logic kind of dictates you would get this information from Eaton, right?
You'd think so.
You'd go to Eaton.com, you'd navigate to their investor relations page, and you would watch their official, legally compliant stream. But this text immediately proves we aren't doing that at all.
Not even close.
Right after the promise of the content, we get this really direct call to action. It says, don't forget to subscribe and follow us on X for more updates. And then it drops a link. x.com/FIFL2.
FIFL2. I mean, that handle right there is the entire story of the modern retail market in a nutshell.
How so?
Well, we have completely moved away from a world where investors pull data directly from, like the SEC's a DJR database, or where they dial into these stuffy institutional webcasts. We are now firmly, irreversibly, in the era of the middleman.
Aggregator economy.
Exactly. Accounts like FiFL2 on X and YouTube have aggressively positioned themselves as the necessary translators between corporate America and the everyday retail investor.
And to be fair, the friction of legacy financial reporting totally created this market, right? I mean, have you ever tried to navigate an official corporate investor relations page?
Oh, it's a nightmare. It's so clunky.
It's awful. It is designed by corporate lawyers to minimize liability. It is absolutely not designed to maximize user experience.
Right. They just want to check the compliance box.
Yeah, and the webcasts themselves are often just audio only, and you have these CEOs reading prepared statements in this just monotone drone. And then the Q&A sessions, they're entirely dominated by institutional analysts asking these hyper-specific questions about, like, regional supply chain minutia.
Stuff that you as a retail investor literally cannot act on.
Exactly.
Well, those legacy systems are built for a completely different audience, you know? The institutional analyst actually needs that regional supply chain minutia for their discounted cash flow models.
Right, they need the weeds.
But for a retail investor, the person just scrolling on their phone while on the train, they just need to know if their basic thesis is still intact. And that is exactly where a FIFL2 steps into the void.
They act as the filter.
Yeah, they download the clumpy webcast, they slice out the monotone drone, they isolate the, 3 minutes where the CFO actually talks about margin expansion.
Right, and then they slap a highly clickable thumbnail on it and serve it directly to your feed. It's democratization through filtration.
But wait, let's explore the danger of that translation process for a second. Because if we are relying on a social media account named FiFL2 to give us our critical Q4 2025 metrics, aren't we introducing this massive game of telephone into our investment strategy?
Oh, without a doubt.
I mean, what happens to the integrity of the data when it passes through an aggregator? Because their primary algorithmic incentive is retention and engagement. Right? It's not strict factual accuracy.
That's the scariest part. The editorial choices become the primary risk factor for you, the viewer. Think about it. An aggregator compressing a 60-minute call into an 8-minute recap is forced to make highly subjective decisions about what actually constitutes a key financial metric.
So they have to leave stuff out. They have to. So if Eaton reports a massive headline-grabbing revenue beat, but they also bury a terrifying restructuring of their debt covenants deep in the Q&A section of the call, well, the algorithm dictates that FIFL2 should focus exclusively on the revenue beat.
Because the debt restructuring is boring.
It's incredibly boring. It doesn't generate likes. It doesn't get retweets on X. It doesn't make a good thumbnail.
So you are essentially outsourcing your due diligence to someone who is literally optimizing for virality.
Exactly. They are translating a legally binding corporate document into pure entertainment.
Wow. And if FIFL2 misunderstands the nuanced point about forward guidance, or say, they completely misinterpret the impact of a new product line, tens of thousands of retail investors might reallocate their portfolios based on what is basically an entertaining hallucination of the actual data.
And the cascading effect of that is just terrifying when you consider the sheer volume of capital moving through retail channels today.
Yeah, we are talking about millions of dollars shifting around based on a summarized, remixed version of a corporate event.
Yeah, and here's the thing. The aggregators are deeply, fundamentally aware of this risk. They know exactly what they're doing. They know they are walking a tightrope over an active legal volcano.
Which perfectly explains the sudden whiplash in the source text we're looking at.
Oh, the tone shift is incredible.
It is, because the moment they finish asking you to subscribe on X, the tone violently shifts from this upbeat marketing pitch to a dense, paranoid legal defense. Let me read the disclaimer section from the text.
Go for it.
It says, disclaimer. This video includes segments from official corporate earnings calls and presentations used for educational and informational purposes under Fair Use, Section 107, U.S. Copyright Act.
That single sentence is load-bearing. I mean, it is the only thing keeping the entire aggregator economy from collapsing overnight.
Really? Just that one sentence?
Yes. We have to look at the underlying tension of ownership here. An earnings call is not public domain. The slide deck, the audio of the executives, the official transcript, all of that is the proprietary intellectual property of Eaton Corporation.
Right, and they spent millions on the lawyers, the auditors, the production team just to create that event.
And it absolutely belongs to them. So when an account like Fifel2 downloads that webcast, cuts out a 3-minute segment of the CEO speaking, and uploads it to their own channel to run ads against it, they are fundamentally taking someone else's expensive IP to build their own audience.
Right. If they just ripped it raw without any commentary, Eaton's legal team could issue an automated DMCA takedown notice
Instantly.
which would nuke the video and potentially get the Fifel2 account permanently banned. So they have to protect themselves.
Exactly. To survive that automated legal machinery, the aggregator must invoke the magic words. Section 107 of the U.S. Copyright Act, fair use.
Educational and informational purposes.
Right. By explicitly stating that the segments are used for those purposes, they are building a preemptive legal shield. They are arguing to the platform's content ID algorithms and to any passing corporate lawyer that they are not pirates.
They're framing themselves as educators.
Yes. They're saying, we are critics. We are journalists providing commentary on a matter of public interest.
Okay, let's unpack this because the comparison to reaction channels is inescapable here.
It's very similar, yeah.
It's exactly like a hip-hop artist sampling a classic jazz track or a YouTuber doing a reaction video to a new movie trailer. They're using someone else's IP to build their audience. But the economics here feel entirely different.
Oh, completely different.
Because when a YouTube creator reacts to a movie trailer, the movie studio often looks the other way because, hey, it's free marketing for a consumer product. They want you to buy a ticket. But Eaton isn't selling movie tickets.
No, they're communicating highly regulated financial data to their shareholders.
Right, so an aggregator slapping their own logo on Eaton's data and monetizing it introduces a completely different kind of market tension.
It does. And if you look at the 4 factors of fair use, it's the purpose of the use, the nature of the copyrighted work, the amount used, and the effect on the market. That last one, the effect on the market, is where this gets incredibly complex. Because Eaton wants maximum distribution of their earnings results, right? They want the market to have the data.
Sure.
So does Fifel2's video actually harm the market for Eaton's original webcast?
Well, I mean, you could argue it actually expands it. Fifel2 is reaching that mobile-first retail investor that Eaton's legacy IR page could never dream of capturing.
True. But Eaton loses total control of the narrative. And that loss of control is a massive liability. Let's say Fifel2 splices the CEO's words out of context to make it sound like the company's going bankrupt, and the stock tanks based on that viral video. Eaton has now suffered a material market impact because of a derivative work.
Which is precisely why the disclaimer in our source text continues with such aggressive, specific denials.
Right, look at the very next sentence.
It says, no affiliation or endorsement by the companies mentioned is implied. All content rights remain with their respective owners.
That is a firewall.
They're essentially screaming, Eaton doesn't know us. Eaton didn't pay us. Please don't sue Eaton if you lose money watching our video.
They are completely isolating the liability. Because if a viewer assumes that Fifel2 is an official partner of Eaton and makes a disastrous trade based on some error in the video, that viewer might try to drag Eaton into a lawsuit.
Claiming the corporation was responsible for the misleading communication of its quote-unquote partner.
Exactly. The aggregator has to sever that perceived link immediately and unequivocally to protect both themselves and the corporation they are feeding off of.
It is such a profoundly weird symbiotic relationship. You have these multinational corporations, heavily regulated by the SEC on one side, and on the other side, you have these scrappy, anonymous social media accounts locked in this adversarial dance.
Yeah, it's wild.
The aggregators absolutely need the corporate IP for raw material. I mean, they have no business without it.
Yeah.
And ironically, the corporations quietly kind of need the aggregators to translate their data for the modern retail audience.
They just can't ever admit it publicly.
Right. But let's focus on the name Fifel2 for a moment.
Yeah.
You mentioned earlier the trauma response of the disclaimer.
Oh, yes. The number 2.
Yeah, the 2's a massive tell, isn't it?
It is the biggest clue in the whole text. In this digital ecosystem, a 2 at the end of a username almost always implies that the original account Fifel, or Fifel1, was suspended, banned, or deleted.
Oh, wow. That completely changes the context of all that legal jargon.
Doesn't it?
Yeah. If they are on account number 2, it means they have already lost a battle with the platform's copyright strike system.
They have been burned before.
So their heavy reliance on Section 107 isn't just some lawyer's friendly advice. It's a literal battle scar. They've had their channel vaporized before for flying too close to the sun with corporate IP, and now they're building the thickest legal armor they can possibly muster.
Exactly. It highlights the precarious nature of this entire shadow industry. I mean, your entire business model relies on scraping data from titans of industry and just hoping their automated legal bots don't squash you before you can cash out the ad revenue.
That sounds exhausting.
It requires constant vigilance. You have to edit the video just enough to be considered transformative under the law, but you have to keep enough of the original corporate flavor to satisfy the viewer's desire for authenticity.
But here is the ultimate hilarious irony of this entire legal tightrope.
What's that?
After spending all this effort, promising you the key metrics, and begging you to follow them on X, and carefully navigating the treacherous waters of the U.S. Copyright Act just to keep their video monetized, look at the very next instruction they give the listener.
Oh, the redirection.
Yes, the text literally reads, "For more information, please refer to the investor relations pages of the companies featured."
It's beautiful. It perfectly undermines their entire value proposition.
It totally does, because the only reason you are watching Fifel 2 in the first place is to avoid going to the investor relations page. The aggregator's entire pitch to you is, hey, we did the hard work, we sat through the boring webcast, we read the dense 50-page PDF so you don't have to. And then their concluding legal advice is to go do the exact thing they promised to save you from.
It is the cycle of information beautifully and quite cynically encapsulated in one sentence. From a legal standpoint, it is the final wash of the hands.
Just wiping them clean.
Yeah. They are telling you, look, we gave you our educational interpretation, but if you want to make actual financial decisions, the burden of verification is entirely on you.
Don't blame us.
Right. They are happily consuming your attention, but they absolutely refuse to take responsibility for your financial literacy or your trading decisions.
Which really forces you to realize the true nature of the product here. The product is not financial advice.
No.
The product is not even really financial data. The product is convenience disguised as an edge. And the moment things get serious, the aggregator points you right back to the official corporate source that they just finished remixing.
It is a critical lesson for anyone listening who navigates the modern market. You know, the democratization of data through social media is a double-edged sword.
How do you mean?
Well, yes, the barriers to entry are lower than ever. You don't need a Bloomberg terminal to get earnings updates anymore. You just open an app. But the cost of that convenience is the total removal of guardrails.
You are entirely on your own.
You have to be your own editor, your own fact checker, and your own risk manager.
Because the person giving you the summary is optimizing for a totally different set of metrics than you are. You are optimizing for your portfolio growth. They are optimizing for their click-through rate.
Two very different things.
Very different. And that misalignment of incentives brings us to the final, and I think most revealing clue in our microsource, the commercial pivot.
The very last line.
Yes. For inquiries, contact fifelstore@gmail.com.
The word store.
Just that one word, store, completely shatters the illusion of this noble, educational nonprofit endeavor they painted with their Section 107 fair use claim.
It really does. It reveals the architecture of the entire monetization funnel. Because look, ad revenue from a YouTube video or an X thread is fractions of a penny per view.
It's basically nothing.
It's very difficult to sustain a business purely on platform payouts unless you are generating tens of millions of views consistently. So to actually build wealth in the aggregator economy, you have to move the audience off the platform.
I have to get them somewhere else.
Right, into an owned ecosystem where you can sell them a high-margin product.
So let's extrapolate on that. What exactly is a financial aggregator selling in a store? Because they probably aren't selling physical merchandise, right?
Yeah.
Nobody is walking around in an Eaton Q4 2025 EPS beat hoodie.
As funny as that would be, no. In this specific niche, the store almost certainly represents digital access.
Okay. Like what?
Well, think about it. The raw material is free. Eaton's earnings call is public data. But by applying a layer of editing, a layer of perceived expertise, and a layer of convenience, the aggregator creates a premium product out of thin air.
They manufacture value.
Exactly. So they are likely selling access to, say, a private Discord server where they drop exclusive analysis. Or they might be selling a premium Substack newsletter that goes deeper than the free video. Or, very commonly, they might be selling an online course on how to trade earnings reports.
Oh, right. They are selling the shovel in a digital gold rush.
That's exactly it.
And it really makes you view that entire paragraph of text differently. The promise of the Q4 metrics, the plea to subscribe on X, the careful legal maneuvering with the fair use stuff.
Yeah.
None of it is the actual end game.
Not at all.
It is all just top-of-funnel marketing. The video about Eaton is just the bait on the hook, designed to catch your attention so they can eventually route you to the store.
It maps the entire life cycle of modern digital attention perfectly. You leverage free corporate IP to capture the algorithm, then you game the search engine optimization to capture the retail investor's intent.
With the Q4 earnings keywords.
Right. Then you invoke copyright exemptions to protect the asset. You explicitly deny liability to protect yourself legally. And finally, you funnel that captured attention into a private commercial environment. It is a brilliant, ruthlessly efficient business model.
It's kind of awe-inspiring when you lay it all out like that.
Yeah.
And it is completely invisible unless you stop and dissect the metadata surrounding the content you consume, which is what we're doing today.
Most people never look at the scaffolding.
We interact with these aggregators every single day. We scroll past their videos, we skim their threads, we absorb their summaries, rarely stopping to consider the structural engineering of the information we are ingesting.
And that reliance on aggregators fundamentally alters the velocity of the market itself.
Wait, how does it alter market velocity?
Well, think about what happens when thousands of retail investors are reacting simultaneously to a summarized, editorialized video dropping on YouTube, rather than reading the SEC filings at their own pace over a few days.
Oh, I see. It concentrates the reaction time.
Yes. It creates these extreme microvolatility events. A slight misinterpretation by an aggregator with a large following can cause a massive cascade of algorithmic trading before anyone has even checked the official investor relations page.
So the wrapper has basically become just as influential, if not more so, than the actual data inside. The market reacts to the translation before it reacts to the source text.
Which really forces us to ask how sustainable this entire ecosystem is.
Yeah, can it last?
I don't know. The tension between the corporations producing the IP and the aggregators monetizing it will eventually reach a breaking point. As these aggregator channels grow larger, their market impact grows, and that flimsy liability shield of fair use will inevitably be tested in major litigation.
It is the ultimate paradox.
Right.
The corporations spend absolute fortunes trying to control their narrative. They carefully craft every single syllable of their Q4 earnings call to comply with SEC regulations, trying to manage market expectations.
They script everything.
Everything. And then they have to watch helplessly as an account named Fifel2 slices it up, remixes it, and broadcasts it to a larger, more reactive audience than the official corporate channel could ever hope to reach.
The power dynamic has entirely inverted. The distribution channel is no longer controlled by the creator of the data. It is controlled by the aggregator who understands the algorithm better.
So what does this all mean for you, the listener?
That's the big question.
Right. The next time you are scrolling through social media and you pause to consume a quick financial recap video or a thread summarizing a stock's performance, I want you to look at the text surrounding it. Look at the scaffolding.
Read the description.
Pay attention to the disclaimers. Recognize the store email addresses. Understand that you are standing at the very bottom of a highly engineered conversion funnel.
Be infinitely more discerning about the editorial choices being made on your behalf. Question what metrics were strategically left out to make the video shorter. Question what nuance was sacrificed just for a catchier title.
Because they always leave something out.
Always. And when the legal heat gets too high and the aggregator tells you to go to the official source, actually take that advice. The true edge in the market doesn't come from the quickest summary. It comes from understanding the raw data before it gets translated by someone else.
Exactly. We've seen today how these digital middlemen, operating under the fragile shield of fair use, are rapidly becoming the primary lens through which new retail investors view the market. And if this trend continues to accelerate, we really have to consider how it will fundamentally change corporate behavior in the future.
It creates a crazy feedback loop.
It does. Because if the corporation knows that their entire 60-minute presentation is just going to be chopped up into a 30-second TikTok or a 5-minute YouTube video by an aggregator, do they start designing the earnings call specifically for the remix?
That is a wild thought.
That is the provocative thought I want to leave you with today. Will CEOs and CFOs eventually realize that the dense, monotone reading of statistics just isn't serving them anymore? Will they stop talking exclusively to the institutional analysts sitting in the room and start performing directly for the algorithms?
Just serving up sound bites for Fifel 3.
Right. Will the Q4 earnings call of 2030 look less like a legally mandated financial disclosure and more like a highly produced influencer video designed to go viral? I mean, when the wrapper becomes more important than the candy makers eventually have to change their recipe. Think about that the next time you hit subscribe. Until next time.